Okay. This question, this session deals with cessation of a business. So when you close down a business. So I'd like you to think about when you might get it in an exam. Okay. So this is something that's very, very common in exams. You might get this when a company gets liquidated. So there's all sorts of stuff within the syllabus when a company gets liquidated and then it needs to sell off all of its assets. So there could be a VAT calc on closing down of your company. The other time it can happen is when someone dies. Okay, so you could get this with trusts and deceased estates and all of that. And someone, a lawyer, is got a practice open, the lawyer dies, and you've got to close down the business itself. So let's just go through what the rules are for cessation of business. Okay, so general rule. It says there's a deemed supply when businesses cease to trade in terms of section 8.2. As this is a deemed supply, these goods need not be sold. So the lawyer dies. Okay, we stop trading because without the lawyer, you can't run a law practice. In terms of section 8.2, we deem to have sold all of the assets. This is irrespective of whether you actually sell the assets or not. One thing you do know is with the lawyer being dead, you cannot carry on the practice itself. So time of supply, the goods or rights are deemed to be supplied in the day immediately before the business is ceased. So basically, guy dies today. We stop trading today. We deem to have sold all of the goods. The value of supply, what are we going to do? Lower of cost or open market value of an asset. Okay, lower of cost or open market value of an asset. Now, guys, please understand, if it's a partnership, it's quite possible that the partnership will carry on trading and then we don't need to do this. If the business carries on trading, we don't need to do this. This is when we stop trading within a business. It says Mr. A, lawyer, died on 3 March and the executive decided to close his practice down on 18 March 2021. Okay, so cessation of a business. I'm not doing all of the stuff in here. So what's happening here, guys, is it says Appendix A, market value of assets at the dates of cessation of the business. So here's a list of all of the assets within the business itself. And guys, you need to know what has happened with each of these assets to be able to account for all of the tax implications on these assets themselves later on. So we're going to read through the question now, and we're going to see what we can understand as part of this itself. Okay, so let's go through it. You need to understand change in use with this as well, just as a matter of interest. So we'll go through it. It says, Mr. A, lawyer, died on 3 March. Executive decided to close his practice down, and they closed it down. So we're going to have to do a cessation of business calculation. But in the required, that's only part C inside the required itself. Calculate the amount of VAT on cessation of the business. Let's have a look here. It says tax year 1, March 20x20 to 28 Feb. It says throughout his previous tax year from 1 March 20x20 to 28 February 20x21, his VAT apportionment percentage was 65%. Okay, so at the beginning of the year, 65%. He earned 4 million in legal fees and commercial rental income of 6 million in residential letting income. He was ill during the year and his legal income has been vastly lower than in previous years. So guys, at the beginning of the year, it was 65. At the end of the year, it had dropped to 40%. How do I know it's 40%? Because 4 million legal fees and 6 million residential rent means that only 40% is VATable. Okay, so I've got a change in use here. And what happens with partial changes in use? At the end of the year, we try to see whether something has gone down in use. So it's gone down from 65% to 40% during the year. So it says asset details. Next one. He ran his practice from a flat that he bought for $575 from a developer. On acquisition of the flat, he claimed the full 65% VAT. So let's talk about what's going to happen here. This flat is used for both. It was 65%. It's now only 40%. So what are we going to have to do at year end? It is a partial change in use. There is a movement of more than 10% and the asset cost more than 40,000 Rand. Therefore, what are we going to do? There's going to be a VAT adjustment. Now, guys, does this mean we claimed more VAT or does it mean we claimed less VAT when we bought it? It means we claimed more VAT. So we're going to have to give that back. So what's going to happen? There's going to be an output, 25% less used for VAT, times by lower of cost or market value, always for a change in use, for partial, times 575, times 15 over 115. And that's a partial change in use, output at your end. It says there was a pool motor car that cost 230,000. Input VAT was denied on the acquisition of the motor car. No input, no VAT adjustment. Do you understand? There's no VAT input there. I don't need to adjust anything. Even though it costs more than 230,000 Rand, I don't need to adjust it because there was no input VAT when I claimed it because it was input VAT denied. The practice is used for both. It's 25% less VAT, so I've got to give the VAT back to SARS. It says he purchased a computer that cost 11.5, upon which he had also claimed 65% input VAT. No adjustment. Why no adjustment? Cost less than 40,000 Rand. For a partial change in use, you don't need to adjust when there's a partial change. It says there was a law library of legal books that cost 50,000 Rand. 100% of the VAT was claimed on the law library as it was all used exclusively for running of the law practice. There's no VAT adjustment here either. Why is there no VAT adjustment? Because it's all for the law practice. It's got nothing to do with residential accommodation. We only adjust for the assets that are used for both. We don't need to adjust for the assets that are used for one item. It says he has an investment portfolio of residential buildings that cost 40 million Rand. These were rented out as residential accommodation and no input VAT has been claimed. Again, no VAT adjustment. Why? Because this is all residential. We only do a partial change in use for where something's used for both. Carrying on. There were also tools used to fix buildings that had a total cost of 115,000 3 years ago, as well as a bakkie that cost 130,000 that was used to transport repair crews from building to building. At the time of acquiring the tools and the bakkie, Mr. A had agreed with SARS that he would claim 20% of the VAT on these tools and the bakkie, as he had both commercial and residential properties within his property portfolio. Commercial buildings were 20% of the total. Okay, so I only claimed 20% for these. The commercial buildings were sold during the year, leaving only residential buildings. Okay, so what has happened? I claimed 20% here. Okay, it has now gone down to 0%. Is that a partial change or is that a total change? It is a total change. How do we know it's a total change? Because there's a 0% in it. Okay. So what does it say? It says the commercial buildings were sold on September 12th, 2020, leaving only residential buildings. It was decided on that date. The bakkie would be used within the business for both the law practice and for repairing buildings. So what's going to happen with this one? We're going from 20% to 65%. We're going from 20% to 65%. This is a partial change in use. So what are we going to do with the partial change in use, guys? We're going to say it's 45% times by lower of cost or market value times 15 over 115. And that's what we're going to do with the Baki. It says the tools would continue to be used for the residential buildings only. So this one's gone from 20% to 0%. This is a total change in use. It's done immediately in September. This one is done at year end, because remember, partial changes in use are only done at year end. And what are we going to do? We're going to say the tools will continue to be used. The market value of the tools were 5750. At year end, the tools were worth 4,600. So what are we going to do? We're going to say in September, 100% output VAT. Okay. And that's because we are now using it only for residential. We're going from 20 down to 0. And remember what we can do now? We can claim 80% of the input VAT back. Okay, because we only claim 20% of it originally. And we can claim. So we need to just bear that in mind. So that's how the calculation would work on a total change in use. Okay, so you guys can have a look. I think you should do the question and try to do it by yourself. But now we can actually do everything with the cessation of business, because we need to know what's happened with each of the assets. So guys, the computer, what are we going to do with the computer itself? Okay. So let's have a look to see what happened with the business itself. Okay. The computer, let's have a look. No adjustment. He's claimed 65% input VAT on it. So what are we going to do in the cessation of business then? It says computer with a cost of 11.5 and an open market value of 4.6. What is the rule with cessation of business? We sell it for lower of cost or open market value. Okay. This one has gone from 65% and it gets sold. So what are we going to do? We are going to have output VAT of 100% times by 4,600 times 15 over 115. Because what happens when we've got an apportioned asset when it gets sold? We charge 100% output. And what would we be able to do? Claim 35% VAT on 4.6 times 15 over 115. Because we claimed 65% when we bought it, that means there's only going to be 35% VAT left to claim when we sell it. Motor car with a cost of 230 and an open market value of 130,000 Rand. What are we going to do with that, guys? No input VAT claimed, no output VAT needs to be charged. That's what will happen with number 2. Okay, so no input VAT claimed, no output VAT that needs to be charged. It says trade debtors, law practice, owing of 400,000, 57.5 was considered to be a bad debt. The law practice is 100% VATable. Because it's 100% VATable, what are we going to do on closing down the business? We will claim a bad debt of 57,500 times 100% times 15 over 115. It says a creditor outstanding for 45 days. Now what happens is if you close down something, whatever you haven't paid for, you have to give SARS the VAT back. So 6,900 for the law practice. We got to give the VAT back to SARS. And it's for the law practice, so we're going to give 100% back to SARS. There's 464 residential accommodation. There's nothing to give back to SARS because this is an exempt supply and we didn't claim VAT on it in the first place. It says creditors outstanding for 480 days, 34.5, all the law practice. If you remember back to earlier, what happens? If something is outstanding for more than 12 months, we need to give the VAT back to SARS. If something is not paid within 12 months, this is more than 12 months, so we've already given the VAT back to SARS. Therefore, there's no VAT on this. Okay. Now, guys, I want you to just understand the way that I've drafted this example is I'm showing you one of each and every single type of thing you could ever find within a cessation of business question. And because I'm doing that with you, you should be able to use this as a teaching example to prepare for anything in the exam. The next one says flat bought for 575, open market value of 690 on the date of ceasing business. So what did we do with the flat? The flat, we adjusted from 65% down to 40%, if you remember, for the flat. So the flat's on 40% at this point in time. So what are we going to do? We're going to have output 100% minus input. If I've only claimed 40% on the flat, I can now claim the remaining 60%. Because what happens when I sell something that I've only claimed 40% VAT for, outputs at 100%, and I get to claim the remaining 60% of the VAT as input. The bucky now, guys, what's happening? We have claimed 65% on the bucky. Per the question, there it is. We went from 20% to 65. So what's going to happen with the bucky? Our output is going to be on 100% minus my input. I've only claimed 65%, so now I get to claim the remaining 35%. Residential buildings, no adjustment. They are exempt. There's no VAT on residential buildings. Law library, guys, was 100% VAT. Therefore, there's 100% output on it. Okay, but no input claim because I did claim 100% on it. And then the tools with a cost of 115. Remember, we went from 20% down to 0% for the tools. The tools were 0% VAT. Therefore, what happens when we sell them? They're exempt. We don't need to make an adjustment for them. And I know that this is going to seem very, very hard. But what I've done here is I've done everything as hard as I could possibly make it to show you what happens when there's cessation of a business. Okay, with all sorts of different percentages. So go and have a look at this. It's got to be easier than this. So all assets are deemed to be sold. Okay, and you need to see whether they're exempt or had 100% output or there was a percentage with them. For all of the items that have a percentage, remember, output is at 100% minus the remaining input that you get to claim for it. So that's there. So that's on cessation of a business. Okay, and I know that that is hard. And that is probably much too hard for any exam. But if you can understand that, you should have no problem in doing cessation of business.